All right. Now, when you start a small business, or let's just say that you are a business owner or you own this small medium enterprise that you're operating, and you are going to have several methods in which your clients are going to pay you. Now, if you look at Mama Mboga and those people who normally sell things on the road, they are going to use different methods of whereby clients can be able to pay them. You can either pay through cash, you can either pay through M-Pesa, and when it comes to M-Pesa, there are some people who have put a pay bill account, their pay bill, they have linked their payments through the bank. And then there are those who use Pochi la Biashara, and so on and so on, the one for Safaricom. And then there are those who use till numbers. All right. Now, these are very good payment methods for convenience and for the security of your money, and so that you can be able to track your sales for the day, so that when you sit down, you can be able to see how much that you have gained. But ladies and gentlemen, our topic of today is not about how clients are going to pay you. No, I want to discuss something very important that is associated with these accounts, or how the clients are going to pay you, and the benefits that are associated to these particular accounts. Now, you say that you are a small business owner and you have just, for example, in most cases, for those people who are starters, if you are a starter, is you are new in business and you are trying to make this business of yours grow, and you have not gathered a lot of information. Therefore, you have not even studied the dynamics of the market and see how your business is maneuvering through the market. And you realize that a lot of customers have not realized that actually you own that particular business or the services or the products that you're selling. So, when you start that particular business, you are going to form a relationship with your bank. And how do you form a relationship with your bank? It is through that pay bill that you normally, these pay bills that the banks are going to give us. For example, Equity Bank and KCB Bank, for example, the 247 pay bill, and the one for KCB Bank, I don't know, 222 and something like that. So let's talk about pay bill. All right, pay bill number. Now, when your clients are going to pay for the services that you have given them or for the products that you have sold them, either you are operating a kiosk, or probably you have a mini mart somewhere, or either you are selling clothes and so on and so on. So you have this pay bill where clients are going to pay you. Now, this pay bill has been linked through a direct to your account, whereby if they pay through that pay bill and the account number, that money is going to go direct to your bank account. All right, that money is going to go direct to your bank account. Now, when that money goes direct to your bank account, what you form is what we call a relationship. All right, a relationship. What you form is what we call a relationship with the bank. That means the bank can be able to see that, oh, this person is owning a business, and through the pay bill, we are seeing some money coming in. For example, today we have received 5,000 or 10,000, or you have made sales of 50,000 or 20,000, whichever, depending on the kind of business or the size of business that you're having. So you're going to form a relationship with the bank. Now, in layman's language, normally say, when a bank decides to give you a loan, it normally looks at the inflows. Not so much, it doesn't concentrate so much on how you spend the money, but how you receive the money. That is where the core business lies, or that is where they normally check so much, so that they can be able to see how much are you receiving at a particular period, for example, a month. Now, let's see, January you received 50,000, Feb you made sales of 40,000, then April you made sales of 30,000. So your inflows are going like this. So when they do the average, they can see at least in a month in your pay bill account, you can be able to receive sales of 35,000. Now, because the bank has automated their systems, they are going to calculate on how much they can give you as mobile loans. Now, that is when you find small business or small medium enterprises or the owners of those particular businesses. For example, in such cases, the starters or even those people who have stayed in those particular business qualifying for what we call mobile loans. Mobile loans, all right? They qualify for what we call mobile loans. Now, ladies and gentlemen, if you don't know what is a mobile loan characteristic number one is a loan that you are going to access through your phone. Very quickly, you're just going to say that the amount I need is this, and then immediately it pops on your screen, and you can be able to qualify for that particular loan. Now, apart from that, a mobile loan is going to be processed very quickly because it's something that you can be able to access through your phone, so you don't have to do paperwork and so much and so on. Now, it is a loan that is going to be paid in a short period of time. All right, it's a loan that is going to be paid in a short period of time. For example, most mobile loans, for example, if I give you an example of KCB Bank, you're going to get a mobile loan if you own a business and you're operating through the pay bill, and they can see that there's some money that comes in each and every month. You can be able to qualify for a mobile loan there. All right, now the level at which that you're going to qualify, for example, I normally see that most starters qualify from 50,000, 38,000, all the way to 300, because they normally have a limit of up to 300,000, and from there, if exceed the limit, then you can be able to apply for unsecured loan and other kinds of products of loans that the banks are going to offer you. Now, this conversation that we are having right now, it's not so much dependent on the mobile loans that you're going to get on the bank. But what I want to talk about is actually the dangers of a mobile loan. Because remember, a mobile loan is a loan that you're going to pay with 1 month. Because the one that is you're going to pay with several months, for example, 6 months or 4 months, that one is a salary advance or a special advance that you're normally given by the bank to finance your financial needs. But this mobile loan, in most cases, characteristic is it's going to have 1 month repayment. And if it has 1 month repayment, you will have to pay back with an interest. And this is where people make the worst decisions when it comes to mobile loans, because mobile loans can either build your business or can mess you up completely, and even they can wipe out the stock that you're having in that particular business of yours because of what we call addiction and so on and so on. Now, I'm going to take you step by step on how the mobile loans can mess up with your financial decisions, and I'll tell you this in a very open environment, and I'm not going to hide you anything, because this one has happened to a lot of people. This one has happened to a lot of people. Now, ladies and gentlemen, check this out. If I take just an example of KCB Bank, and you have this small business, and you have stayed in that particular business for at least 6 months, and KCB Bank has given you a limit or has given you a text that you can be able to qualify for a mobile loan of probably, let's say, 50,000. You can be able to qualify for a mobile loan of 50,000. Now, you've seen, oh yeah, this is wonderful, at least I can be able to expand my business. But you do not know that you could even be getting into a deeper hole where you cannot be able to come out. Now, you can be able to qualify for 50,000 as a mobile loan from KCB Bank. And then you get into your account there, your mobile app, and then you can say, oh, I have a limit of 50,000. And then you decide to take that particular money. Now, they are going to tell you that you are going to return that money with an interest rate. Now, in most cases, ladies and gentlemen, the interest rates of these mobile loans, because this is a loan that you're going to pay with only 1 month, the interest rate of these mobile loans are going to range from 7.5% to 10%. Now, we can even use the maximum of 10%, because in most cases, you might even find yourself paying that loan by an interest rate of 10%. So they are going to have a range of 7.5% to 10%, depending on the bank in which you're applying that particular mobile loan. Now, ladies and gentlemen, I want you to check this one out. Now, if you decide to take 50,000 and you apply that particular, look at the logic here and see how you work for the bank for a whole year without knowing. But in real sense, it did not help you, but you thought that taking this mobile loan of 50,000 actually helped you in your business and coming up with structures and so on and so. Now, ladies and gentlemen, look at this. If you take 50,000 mobile loan, and let's say you have gone through the first month and now it's time for paying this particular. Remember, now let's assume it's January. Assuming it's January and you took this 50,000 as mobile loan, and now it's Feb date 1st and you're supposed to pay back this mobile loan. So you're supposed to pay back with an interest rate of 10%. So you're going to take 0.10 times 50,000. So here you pay with an interest rate of what? This is 10% times 50,000. That is 5,000 Kenya shillings. 5,000 Kenya shillings plus 50K. So you pay with 55,000 Kenya shillings. So you are going to pay back that money as 55,000 Kenya shillings. So 5,000 is the interest charged, but 50K is what you borrowed from that bank. All right. So 5,000 is interest charged out of from that loan, and 50K is what you borrowed from the bank. I don't know where you're getting me. Now, remember, in most cases, the moment you subscribe to a mobile loan, it becomes a habit. And I don't know what normally happens to most people, because the moment you start working with mobile loans, you will never stop working with mobile loans. You will find yourself in that mixture of always taking that mobile. The moment you repay that particular mobile loan, 55,000, you find out that you cannot do without it. There is a gap that is going to be created once you remove that particular money. Probably, now, let's say that you took that loan and you decided to add inventory in your shop, or you decided to add more stock in your shop, and then the month has ended. The month has ended, and if you look at the sales that you have made, they are close to 50,000 that you had borrowed. Or let's say you took 50,000. By the time you are taking that particular loan, you did not have any money in your pocket. So you do not have any surplus in your pocket. So you took it and you decided to, of course, you take a loan to do something, to invest it, all right? You took that loan and you decided to add some inventory in your shop. So you take 50K and you decide to add some inventory, all right? Inventory worth 50,000. Of course, when you sell this inventory, it's going to give you some with profits. Now, the month has ended. If you look at your sales for that month, your sales for that month, you have made sales of, let's say 50K. You have made sales of 50K. You already have 50K in cash. You have made sales of 50K, and you already have your sales of, you already have 50K in cash. But remember, when you start lessing your expenses here, you less rent and other expenses, right? Now look at here, you less rent and other expenses, and you find out that you are being left with 20K, or probably let's say 35K. That is the amount that you're being left with. You're being left with 35K or 50K. Now that's when you decide, now if I pay rent first and other expenses, I have confused myself. If I pay rent first and other expenses, I might not be able to pay back the mobile loan. So what will happen? What will happen is I will default. So what should I do first? First, I'm going to look for 5,000. The interest now of 10%. I'm going to look for 5,000. The interest now of 10%. So that first of all, I pay the bank. All right. I pay the bank the 55,000 so that they can see I'm loyal to them. So I have not defaulted their loan. So I'm going to pay bank first. Then immediately I pay. All right, you're getting me. This is what happens to most entrepreneurs, not even entrepreneurs, small business people. Immediately you pay that loan. I'm telling you, even 5 minutes does not end. You go back to the application and you take the money again. All right, again for another month. So you take back the money, 50K again. You pull it back to your account. But remember, you've left 5,000 there. All right. So That 50K is now when you decide to pay your rent, you pay your other expenses, you pay your employee, and so on and so on. And then you are left with probably 35K or 30K hapo. Now, this 30K, you decide, now that because I had sold some stock and those stock were going for 50K or something, now let me try to add some stock with this 30K. Now, when you do that, another month comes and then you're supposed to do again the same thing. You're supposed to pay the bank, but again you realize that you're short of funds. So if you make the mistake of paying your expenses first, then you find out that you're not going to be able to pay back the mobile loan. So what do you do first? You first of all decide that I'm going to look to top up the amount that is needed, the interest. So you pay the 55,000 to the bank again, and then immediately you apply for that, the same amount, the 50,000. You pull it back to your account so that you can be able to pay other expenses. Because if you don't pull the amount back, then you don't have money to pay your employees, to pay your expenses, and so on and so on. And ladies and gentlemen, that is how you're going to find out that you are a slave to the bank and you are actually working for the bank very hard. You are working very hard for the bank without knowing, because without that mobile loan that you took from the first time. Now, the question is, why did you not believe in yourself that you could work with the small stock that you have? And you know, banks are, that is, by the way, let me tell you something. That is the easiest way that banks make money, through these mobile loans, because a lot of small business people have subscribed to these things. All right. And the banks are not going to struggle. People are working for them. Money is working for them. They are going to give you that 100,000 because we are going to have a limit of 300,000 for mobile loans. And then the bank is going to give you even 150,000 as mobile loan. And the moment you subscribe to that mobile loan, they normally know that the moment you put that money in your business and you buy stock and inventory and you expand your business, if you try to pull out that money, it leaves a very big gap. It leaves a very big gap. So what do you do for you to make sure that that gap is not left? You make sure that that money is always there. So it will, itakubidi, when you take the money and you pay the bank back with interest, immediately you pay them back, you take the money again, they are going to update your limit immediately so that you can be able to apply for that loan amount. Because even you in your business, you can see, if I don't take that 50K, there is going to be a gap in that particular business. And you don't want to create that gap because you already put that resources in your business. You already did expansion. There are even people who take mobile loans so that they can move to a bigger room. And the moment you move to a bigger room with that mobile money, and remember, the danger of it is that you are paying this loan with 1 month. Oh, I wish it could be paid with 12 months because you can be able to maneuver around and see whether you can get some money. But now, if you're paying for 1 month, then you have to return the whole 150,000 first and then pull it back to your account. All right. So you see how you're working for the bank very hard. Now, look at the wonders of the world here. Look at the wonders. Now, when you do like that, because you'll never stop taking that mobile loan, and because you have already subscribed to it, remember you paid the 5K for January, you paid the 5K for February, you paid the 5K for March, and so on and so on. So at the end of the year, with the 50,000 that you normally take and pay, take, pay, take, pay. You get what I'm saying? That is how mobile loans are going to work. With 50K, you'll have paid an interest of 5 times 12. That is how much? Is it 60,000? I think this is 60,000. Let me just be sure. This is 5 times 12. This is 60,000. All right. So you'll have paid a total interest rate, a total interest of 60,000 Kenya shillings. Now the question is, with the 50,000 that you normally take and pay back, you have paid the bank at the end of the year, you have paid the bank 60,000 Kenya shillings. But the truth of the matter is, even the 50,000 that you're having right now, even after you have already paid the 60,000, that 50,000 is not yours. It belongs to the bank. The money is not yours. It belongs to the bank. And the painful truth is, that money that you have paid to the bank, in most businesses, you will find that these are the profits that they normally make at the end of the month. But because you have made sales and you think that you have made profits even enough to pay the bank, you are paying yourself, you pay other expenses, and then there is someone else you are working hard for, so that you don't create a gap in your business, and that is the bank, and you have to pay hard for it. So what is my expert financial opinion according to the mobile banks that people use when it comes to businesses? This is how I would advise you. When you start a small business, or if you have a small medium enterprise, kindly, ladies and gentlemen, do not use mobile loans in your businesses. It's going to cost you a lot, because the moment you put that money in your business, and you pull it out, it's going to create a gap in your business. And when it creates that gap, you tend to close that gap with the same money. And when you do that repeatedly, more and more times, what you do is that you pay the bank interest, and then you are left with the principal. And remember, even the principal is not your money. The principal is not your money. Its money belongs to the bank. Eventually, if you decided that you're not going to pay that, you're not going to take that loan again, you're going to pay the bank back the 50,000, and then you are left with nothing. So you'll have paid the bank 50,000 that you took plus 60,000, that is 110,000. Remember, you took 50,000, but what are you paying back? The total amount, 110,000. Now, assuming it was not 50,000, it was 300,000. You can guess the interest. 100,000, that is an interest of 30K, 30,000 per month. If you multiply this one by 12, that one is 360,000. 360,000, ladies and gentlemen. 360,000, and you have been operating with a principal amount of 300,000. So it's way much above the amount that you took. So you can see the level of slavery that is here, and how you're working for the bank. And ladies and gentlemen, I told you, this is how easily banks make money without struggling. Leave alone the long-term loans, the mortgages, and so on and so on. This is how easy banks make money, with the kind of interest that is they are going to subject you to that mobile. You know, the psychological way of doing things that they are going to, this loan you're supposed to pay with 1 month. Now, we are going to put an interest. Now you say, if I'm going to pay with 1 month, then the interest of rate of 10% is enough. Because in most cases for loans, you're going to have a 14.5% per annum. That is yearly. So if you divide 14.5% divide by 12 months, you can see it's a very small percentage. But here is a mobile loan that you're taking for 1 month and paying with an interest of 10%. Now, multiply that 10% times 12. That is 120%, ladies and gentlemen. Be careful with mobile loans. It's very dangerous. It can create a very serious gap in your business. And to close that gap, you will have to stay in that chains, in the chains of mobile loans, and you will never come out of it. And the only way to come out of it is to actually create that gap. And through investment of the money you already have in your business, you just try to close that gap over time. So mobile money, when it comes to business, it is a big no. Just avoid, try as much as possible to avoid. Even salary advance and so much and so on, just try as much as possible to avoid it. It's not going to help you in any way. It's just going to ruin your business. And in most cases, you might find yourself, you have closed that business so that you can be able even to pay the bank back. So ladies and gentlemen, when it comes to that, when people default, there is the risk. You see, there are 3 things that comes out here. The first thing is that you default the loan. When you default, remember, you started being addictive. When you became addictive, it's not even addiction. It's the situation that is forcing you to take that particular loan so that you can close the gap. Now, when you close that gap or you become addictive to that particular loan, there is the risk of your information being shared to the debt collectors, because when you default that particular loan, that is where you now start receiving calls from anybody. Oh, unapigiwa na huyu. Oh, you start seeing spam in your phone and so on, and then you wonder, who has shared my information? The bank has shared your information for this kind, because remember, there is no security for these loans. You just qualified because you had some sales coming in or money coming in frequently in your bank account, and that's why the bank trusted you to give you that money. And that's how the bank employed you to work for them and actually give them money. All right. So be very careful with bank loan, with the mobile loans. They can cost you dearly, and we don't want that for for people. All right. So ladies and gentlemen, this information only comes from Xfinop Accountancy and Insurance Consultancy. And this is another reason that I normally tell you that you should stay subscribed in this particular channel, because this is what we do. We share information to do with finances, to do with businesses, and how you can get extra sources of income, and so on and so on. My name is Sir John Mweri. If you are seeing me for the first time, I'm a professional accountant with Xfinop Accountancy and Insurance Consultancy. So make sure you subscribe to this particular channel. Make sure that you put on the notification bell and put a comment on the comment section. Say what you feel about this particular video. And if it gives you interest enough, you can share it to your friends so that you can have a lot of people educated. Ladies and gentlemen, mobile loans, when it comes to business, 1 month loan, whichever, even 2 months or 4 months, it's a big no. Just try to grow your business naturally. Do not force issues, because this one is going to cost you and it's not going to help you in any way in your business. Thank you so much. That was my time. See you on the next.